If everyone could take a seat, please. We're going to start the next program, which will start with a short, quiet please, with a short video. If I could have everyone's attention, please. We're going to start the next program while you're eating lunch, and it'll start with a short video that back in the day before television, they had movie clips that would show, newsreels that would show at the movies, and this one is from 1935.
'28 was a good building year. Almost $3 billion worth of new residential construction saw the light of day. But in 1929, even before the Depression became general, building dropped off to slightly under $2 billion. Year after year throughout the Depression, this decline continued. Each succeeding drop meaning thousands more men laid off in the building and allied industries. Until in 1934, all of the new homes built in the United States were worth only $227 million. A decline of 92% from 1928. But due to the stimulation of the National Housing Act, 1935 presents a different picture. From every section of the country come reports.
We're going to try to get the volume up a little bit here. But you can read the news headlines. This was, I think, 1935. Was when the so FHA was stood up. It was set up under the National Housing Act of 1934. That's as loud as it goes. Okay, 1934, and so then it began operation in 1935, and let's begin. Let me just.
It's a vastly increased building activity. Now in these pictures, we show you a few of the thousands of houses of all types that are currently under construction as a result of this building boom. We show you a few of the hundreds of thousands of men whom it has put back to work, some of them after years of idleness. Carpenters, bricklayers, masons, plumbers, men from every division of the building trades are getting an honest day's work. And this reemployment is not limited to the building trades. For every man put to work on a house, several more are engaged in making the needed materials and transporting them to where they are to be used. This coffee and that comes out of a pay envelope tastes a lot sweeter than the same food when it's bought with a relief check. This tidal wave of new construction is an important contribution to the economic rebuilding of America. Home ownership is the basis of a happy, contented family life. And now, through the use of a National Housing Act insured mortgage, is brought within the reach of all citizens on a monthly payment plan no greater than rent.
So this is the button that you see there. Vintage 1935. This is vintage. This is like brand new, and I have George Mann to thank for putting me on to the source, and that's where I've gotten much of my FHA memorabilia, as it's called. Susan, where did Susan go? Oh, there's Susan. Okay, great. So I'll start with mine, and you have a number of handouts. They include the 1936 FHA consumer brochure, which we've reproduced for you. This is the 1935 version of it. and the 1936 was a little more expansive, so we decided to reproduce that one. You also have handouts besides the presentation. This is the Fannie Mae random sample that I mentioned. And you also have the bibliography of historically significant valuation and mortgage risk documents that was developed subsequent to our last meeting, last conference in July and August of last year. And you also have one more, the letter that I referenced earlier from 1989, the 25th anniversary of FICO score that was sent to me, and on the back is the odds chart that shows what the distribution of FICO scores was for new real estate approved accounts. So these would be new mortgages. And you'll see I have a series of these documenting points in time from the late 80s through the mid-aught years. So, so long-term home price appreciation rates are actually quite modest and volatile, and those averages mask a tremendous amount of volatility. As I mentioned earlier, there's no diversification when one's wealth is in a single asset. If it goes up, it's great. If it's leveraged and it goes up, it's even better. But if it goes the other direction or stays pretty constant and you have to move, you could be in a world of hurt. As Chip Case said in July, the housing market is a crapshoot. It's really the equivalent of playing the roulette wheel and betting on, a 7 is going to come up. Excessive leverage tends to promote that volatility. This is what we call the spaghetti chart. It's the house price volatility for 50 metropolitan areas, most of the largest ones. There are a couple missing, but in general, they're the largest. The green are California. As you heard earlier, California is the volatile state in the United States by far, and within California, Riverside, San Bernardino is the poster child. The reds are other volatile areas, Boston and New England and the Northeast, where these lines up here. And then you have these black lines that represent fairly stable areas, although they have some volatility, but they're places like Raleigh, North Carolina. Somebody mentioned Omaha, Nebraska earlier, and places like that where house prices are fairly stable. We looked at Zillow data further. We looked at 28 cities. This is not the MSA, this is the city proper. And in the city proper, we looked at house prices over 1996 to 2012, and we found that the lowest price zip codes, the zip codes that accounted for, by their price range, 1/3 of the household, 1/3 of the owner-occupied households in a city proper, we broke it up into thirds, bottom third, middle third, top third, and the bottom third in every case had less price appreciation on an annual basis over this period than the top third. And Atlanta is the poster child here, with a huge disparity between the bottom third being negative and the top third averaging over 4.5% per year on an annualized basis. However, even within that, you have a lot of volatility, because the zip code itself, the bottom tier in Atlanta, which consisted of 6 zip codes, itself had tremendous volatility, which you see on the next chart. And so now, instead of annualized, this is the total cumulative price change over this time period, which averaged -10% in the lowest price tier for Atlanta, but ranged from -26% to +2%. So again, volatility is the name of the game, and Atlanta is not unusual. This is the way house prices have been for a very long time. You tend to look at national averages, and averages, again, are quite deceiving. Now I wanted to report on some new research that we've literally just completed this week. Volatility at the individual home level. This has never been done before, to our knowledge, at this level of quantity. We took Prince George's County, which you've heard a lot about today, and we took 112,000 unique properties using the Weiss Residential Index. That's a property level index. So we had 112,000 individual property indices going back to 1997 through 2013. That enabled us to create 11 time cohorts of 7 years each, starting in 1997 through 97, 98, 99, 2000, 2003, and then 98 to 2004 on. And so that allowed us to create 1.2 million scenarios in Prince George's County based on taking a 30-year loan in one case, FHA type loan based on sort of what today is, LTV, 5% down, interest rate, whatever it is, mortgage insurance premium, whatever it is, the front end premium, whatever it is, and amortize that loan over at a 30-year amortization over that 7 years, calculate the increase in value or decrease in value, calculate the amortization, and then figure out where the borrower was being above water or below water relative to that calculation. And then we did the same thing for the wealth building home loan that we'll be talking about after this presentation. But bottom line, it's a fast amortization, 15-year with even faster amortization than normal 15-year. What we found was that volatility in loan type tremendously impact wealth building at the individual home level. Again, averages can be very deceiving over this entire time period for these 11 cohorts. The lowest third of properties had a $19,000 gain for 29%, but 38% of those properties had negative gains. So again, averages are very deceiving. The median loss for those transactions with a loss was $55,000. And the worst cohort, 2006, had a median cumulative loss of 33%. The 15-year had a very different result, Wealth Builder. The gain was larger because the amortization, what we're calling gain here is really the amortization, how much you've saved through amortization or house price appreciation. You see that while the percentage of transactions with a loss was 26%, that not tremendously less than 38, the amount of the loss was very different, 13,000, and the loss for 2006 was negative 8%. We then did that for the top period, and we found that, not surprisingly, although they're not too different, that the high tiers had a slightly higher gain than the bottom tiers. Remember, Prince George's County, Steve had those demographics earlier. Prince George's County's median income is 80% of the Washington, D.C. area. So it is the low income, by and large, area of Washington, D.C. There are parts of other counties that are low income, but Prince George's County is almost uniformly low income for the Washington, D.C. area. We then did another analysis, excuse me, which looked at how a 30-year loan that was leveraged, in this case, again, a 5% down payment with 30-year term, performed under stress. Stress, again, being defined, in this case, what happened when loans were originated in 2004, 5, 6, and 7. We had them amortized for 7 years, and then it was held, whatever it was at that point. We looked at whether it was above water or below water. And you see from the blue bars, which are the 30-year loans, that 70% had negative equity of at least 10%, and virtually all of them had negative equity over this 4-year period, whereas 99% of the wealth building home loans had 0 to positive equity, with the mode being positive 5 to 10% equity. And the wealth building home loan started at 0 equity. It was 100% LTV. When we go back in history, we find that trouble occurs when there's too much kind of debt, too much of a wrong kind of debt. Long sustained growth in house leverage is unhealthy. That's been mentioned before. I think Michael mentioned that. Jobs create demand for housing, not housing creates jobs. The realtors like to turn it around. but you have to have jobs in order to create demand for housing. And you have to have incomes that are, if house prices are going up, incomes have to go up. Mortgage debt is used to smooth housing consumption, and that's positive economically. It's bringing future consumption forward, and for young people, that's valuable. However, using debt to finance consumption in excess of income is destabilizing, and as we talked this morning, that's been a history of our housing policy. We're allowing much more leveraged debt, much higher debt ratios, which is allowing people to buy bigger houses. And so, as we'll see, FHA in 1934 set a credit box, and it was in that film, that was based on what you were paying in rent today. That's the size house you could buy. That's what the limiting factor was, along with other credit factors. Well, what that did, and if you look at that brochure, you'll see the houses that they suggested that people buy. People were buying the size house that was appropriate to their income. We've been chasing the opposite for over 50 years. We have been saying we're going to allow the credit standards to chase growing house size. And that's not a sound policy. Today, nominal and intrinsic housing debt are at historic highs. I have two different series here. They just happen to end a year apart, just a coincidence. The top one, this one, is the ratio of non-farm residential mortgage debt to non-farm residential wealth. One of the points is, as we found with the land change, it's the change that may be very important. The absolute level may be less important than the change. In the 20s, the late following World War I, the change in debt relative to income or wealth, debt relative to wealth, grew, which meant the LTV, in effect, was growing very rapidly. So people were taking out more debt relative to the value of the house. House prices were going up, but debt was going up faster. And that continued through the 20s. Obviously, in the latter part of the 20s and the early 30s, it wasn't because house prices were going up. That's the V in value, is because the loan amount was staying very high. And so you had the LTV continuing to go up on the existing stock of loans through 1931. The next picks up in 1953 and shows a similar relationship. And again, whenever the debt is growing at relative to house price wealth, we seem to get into trouble. And basically gets back to this: when it grows faster than fundamentals, there's trouble. I'd note that you see that we're at a historically very high level. We reached a peak back in the late aught years and early 2010s, and we came back down, but we're still at a historically very high level compared to any time in our history other than this last cycle. Leverage can take many forms. My research has really identified 9 types of leverage, every one of which was used in excess during the 90s and the aught years. Down payments, we'll see down payments were declining. Longer term loans, we had already gotten to pretty much the standard of being 30-year, but you can also go to interest only. You eventually can go to neg am. You can do all kinds of things that in effect reduce the amortization. Higher LTVs on rate and term and cash out refinances. This is something that I don't think the regulators even today even recognize. When we did our periodic table, we found that on rate and term refinances, the default levels at a 80 LTV rate and term were the same as default levels on a purchase at 90. The default levels on an 80 cash out were the same as the default levels on a 95 purchase. I was not surprised by that, because in 1985, when I was at Fannie Mae, we redid our underwriting based on that real estate cycle we had just been through, known as the oil patch, or COLTA, Colorado, Oklahoma, Louisiana, Texas, and Alaska, and we found the exact same pattern. And in fact, you'll see on that random sample, COLTA is still mentioned. There's a column there, COLTA, because people still had it in their memory. And there's also a distribution of LTVs by purpose, and you'll see that the rate and term refis, and particularly the cash out, had much, much, much lower LTVs in the late 80s, early 90s than purchase LTVs. You also have increase in debt to income ratio. We'll see more about that. Longer loan, I mentioned that. Use of adjustable rate is another way of expanding income leverage. You just, if you create an arm and you don't underwrite it at the fully indexed rate or the rate it will be at the end of 5 years or whatever, some other standard, then you're again adding income leverage. You can expand the definition of income. That was done extensively during the 90s and the aught years, and then reduce documentation. We'll see the impact of that in a minute. And then you can also increase credit leverage. You can also ignore expenses is a way to increase leverage. And DTIs are calculated on pre-tax income. With the exception of the Veterans Administration, the total budget's not looked at. So when FHA says you've got a debt to income of 50% pre-tax, it's not looking at the income taxes, Social Security taxes, the utilities you're paying, the cost of maintenance of property, cell phones, cable, food, clothing, you name it. None of that is taken into account. Cost to commute is not taken into account. This is a huge, huge issue. And it promotes sprawl. It feeds right into that cycle that we saw both in Berlin and in the United States, where as you move out, the land values are lower. Well, that, if the construction costs are roughly the same per square foot, you end up with lower house prices. Then that demand gets pushed out 30 miles. It pushes up the house prices because they, people just, the demand keeps moving out. Why? Because you don't count the cost to commute. If the commute is 2 miles, it's the same as the commute is 30 miles each way. From an underwriting perspective, it's just not taken into account, it's ignored. And DTIs, the purpose of DTIs largely sets the upper limit of a home buyer's buying capacity. That's what it's setting. At whatever the interest rate is, whatever the loan term is, that's setting the maximum limit. If you can expand these things artificially or ignore things, you're in effect allowing them to buy more house. Now I want to switch to the evolution of appraisal and lending theory and practice. From 1890s to 1920s, Richard Ely advanced early research on land economics and appraisal theory. He was at the University of Wisconsin. We've got Steve from the University of Wisconsin here. Mara's just left the University of Wisconsin. Jim Lynn was trained at the University of Wisconsin. Others were also. It's very famous for their real estate academic programs. He recognized, his motto was, under all the land, and recognized that land use is a product of economics, institutional forces, and physical constraints. He studied at the University of Heidelberg, which we think is important because we think he imported some ideas that had been handed down from the time of Frederick the Great. That particular paper is mentioned in the bibliography. And he trained under Carl Neese, who wrote Money and Credit in 1873. And we think this is where this concept of value in use and value in exchange or price starts developing. Then a very important book I recommend anybody who's interested in land valuation read this book. And you don't even have to get much beyond the introduction, because everything that's on this page, on this slide, is from the introduction. Probably the first page of the introduction. He just really put it out there. And as I mentioned earlier, he talked about intrinsic value, and it's correctly derived, in his opinion, by capitalizing ground rent. Exchange value may widely differ from that. And this gets to some extent to Bob's point earlier about looking at rents. And by the way, when you talk about city value, it's not city as we think of it today. It meant non-farm. In 1900, you still had the high preponderance of people in the United States lived on a farm. Valuing farmland was well understood. You were using it for a business purpose. Valuing what he called city land or non-farm land was not well understood, and that's why this treatise is so important. And the value in urban land results from economic or ground rent capitalized. Since value depends on ground rent and rent on location and location on convenience and convenience on nearness, the intermediate steps may be eliminated, and then value depends on nearness. This goes back to what Steve presented with that 10 miles radius by driving to jobs as one indicator of nearness to something of value, a fundamental to house value. Land prices on the outskirts are lower as area increases with the square of the distance. It's just a fundamental, arithmetic. As you move out, that's pi r squared. And so that's why you see these patterns that you see in Germany and you see in the United States. You see the same pattern in a metropolitan area. It's not a perfect pattern, but it's a stylized pattern as you move out. And there are other things that may affect it, but in general, that's the pattern you see. If a new utility arises, both exchange prices and intrinsic values may alter their levels. The key is deciding which is correct. And general financial and economic conditions enter so largely into exchange values that values at times are not based on income, supply, and demand, but represent a condition of the public mind. Again, 1903. If this sounds familiar, it's not a coincidence. Very important that Ely had many colleagues, and they continued working on this subject. Ernest Fisher and Frederick Babcock, too, that I mentioned here. They'll enter the story again in a minute. In the 1920s, lending and appraisal practice was based on, not on intrinsic value, but on point-in-time value, as was mentioned earlier. Property appraising largely became the province of local real estate boards. There wasn't really an independent appraisal operation back then, and they were comprised of realtors who held themselves out as appraisers. Lending standards were quite loose. First mortgages were available up to 100% of exchange value. Second mortgages were even higher. Commonplace for mortgage underwriting to be based on mortgage collateral, ignoring credit and income. Again, sounds very familiar. Fraudulent lending and appraisal practices were rampant. Mortgage-backed bonds were relatively commonplace. That's another fact that people don't tend to remember. Mortgage-backed bonds were commonplace in the 1920s. They all failed in the 1930s. History, as Alex likes to say, does repeat itself. Ely's colleagues laid the foundation for FHA and sustainable lending practices by their work pre-1934 and then at FHA. And again, these are additional books and research done by Frederick Babcock, who became the chief underwriter at FHA, Homer Hoyt, the chief housing economist, Richard Ratcliffe, another housing economist, Arthur Weimer, another economist, and Fisher, Ernest Fisher, who was the chief economist at FHA. In your brochure from 1935, you'll see on the inside cover a statement by the administrator of FHA. Mortgage was just another word for trouble, an epitaph on the tombstone of their aspirations for home ownership. Again, any similarities to what happened during the run-up, during the affordable housing craze of the 1990s and aught years is just purely coincidental. By the way, there was an affordable housing push in the 1920s, 1923 on, led by Herbert Hoover, at the time was Secretary of Commerce, led by Henry Wallace Sr., not the one who became Vice President under FDR, who was Secretary of Agriculture, and Vice President Calvin Coolidge. Were all part of the buy home movement that started in 1923. FHA came up with a way to replace what they call loose and dangerous underwriting with what they termed a straight, broad highway to debt-free home ownership, which again is something we'll keep coming back to today. And second mortgages were a huge part of this. You'll see it talked about in that brochure. They had sizable down payments, a minimum of 20%, maximum 20-year term, more frequently 15, solid borrower credit history, solid appraisals. Remember, this is in the 1930s and 40s and 50s, although down payments did go down some over that time period and terms did move out some. But the 30-year mortgage didn't become commonplace until, in new construction, until the mid-1950s, and on existing construction until the late 1950s, early 1960s. Ability to pay, this is not the ability to repay of Dodd-Frank. This is the ability to repay of the National Housing Act of 1934. That This was imposed on FHA as an absolute requirement: proper income documentation, sufficient income to make regular payments, including review of borrowers' monthly expenses and residual income. That was immediately implemented by FHA with a residual income test and looking at the budget, which is why the VA still has it today. They had fully amortized loans with a ban on seconds. They really were religious about making sure seconds didn't creep into the process. This did create a broad straight highway to debt-free home ownership, and people, our parents and grandparents, burning their mortgages that you may remember. This is a chart of the trends in home mortgage maturities. Again, it's good to have facts, because if you listen to what a lot of people who in the 80th anniversary of FHA will describe what happened, it doesn't resemble the facts. But here are the facts as reported in 1970 by John Herzog and James Early for the National Bureau of Economic Research. There was an explosion in the home ownership rate that took place, 44% in 1940 to 62% in 1960. You saw the one chart I think Michael had that picked up in 1990 or something. Well, the fact is it was 62% in 1960, didn't change much. It was, what, 63% in 1992. Eventually got to 69.2%, now dropped back to 64.8%. But if you take out the people who are in foreclosure and the people who are seriously delinquent, you're back to about 63%. So we've spent 50 years and we haven't moved the needle. They did virtually eliminate foreclosures back in this time period. First 20 years, FHA paid 5,000 claims out of 2.9 million mortgages, 0.2%, with a 9% severity. If you think about that, that's 2 basis points was the cumulative loss per $100 lent. Babcock, in his 1932 book, which was written right before he becomes the chief underwriter at FHA in 1934, and this is why this is very important, because it tells us what these gentlemen were doing and thinking before they went and stood up FHA. Fair market value would be the price that a buyer was, which a buyer were warranted in paying in view of the potential utility of the property. The fact that several hundred purchasers have been found who are willing to buy certain undesirable subdivision lots at exorbitant prices would in no way be presentable as evidence of market value. Value will be determined to designate the concept in which a thoroughly informed buyer is present, and market price will be used to designate the prices in which properties actually do bring in the real estate market. However, he was not talking about an actual real buyer and a real seller in a real transaction. It was a real transaction, but he was talking about a fully informed buyer and a fully informed seller. That was the job of the appraiser, was to act as that fully informed buyer, as if he were a fully informed buyer and a fully informed seller, and determine what was warranted in being paid. So that's why you call it warranted value. Another word for it that I use is the one that Hurd used, which is intrinsic value. There are marked similarities between FHA's valuation for mortgage loan purposes, is what he called it, and Germany's mortgage lending value. So we first thought that somehow, 5,000 miles apart or 4,000 miles apart, 70 years apart, 2 different definitions had developed independently of each other. But now we think possibly that it was Babcock who brought the ideas from Germany in the 1870s, transmitted them to these 5 gentlemen, or at least some of them, in particular Babcock and Fisher, and that became the foundation of what Babcock wrote in 1938. And so I have in red here some of the things that are similar to the mortgage lending value, but the whole point is the valuation is sometimes hypothetical in character, especially under market conditions where abnormalities in price levels indicate the presence of serious quantitative differentials. The 2 value concepts, between the 2 value concepts, warranted value and available market price. And they may be evident particularly under boom and depression conditions. He basically said the only time that a comparable sales approach was appropriate was in a stable market. If it was not a stable market, you would not look to the sales prices as being the determining value for the V in value for LTV. Attention is directed to the fact that speculative elements cannot be considered as enhancing the security of a residential loan. This is almost an exact quote that's in the German approach. And just a second here. Yeah. Okay. There's more you can read. This is from the Fonbrief Act, and so you can see again the similarities that appeared in the 1990s that are very similar to what was in FHA. Now we go to the devolution part. Again, thanks to Susan, who was at the session last year and came up with that term. And from the 1930s to today, policy pressures have been to increase all forms of leverage. Congress kept raising FHA's leverage limits, both LTV and term, starting in 1937. However, the underwriting grid that FHA had and its inability to allow, or its ability to tamp down layering of risk, basically probably frustrated Congress, because Congress would pass these laws and nothing much would happen because it didn't pass the grid test. That worked for about 20 years, and then starting in 1957, and I think you'll see on one of the slides that was earlier today, there was a recession. I think it picks up in 1961. There was a recession in 1960. Well, there was also a recession in 1957 that I remember quite vividly. And Congress amended the National Housing Act 4 times in 5 years. No gridlock there. And then in 1992, as already been mentioned, Congress places Fannie and Freddie in competition with FHA and private subprime. A curious policy whereby low-income home buyers with volatile incomes are encouraged to buy homes in areas with volatile prices using high leverage. And we wonder why they don't create wealth. FHA then abandons the, let's see, what did I get out of? Oh, yeah, abandons the debt-free highway, this is actually documented in 1970. There was a 1963 study that's in the bibliography, but in 1970, in the Herzog early study, they say until 1964, all loans offered for FHA insurance were subjected to risk rating. And they go on to say, but that was abandoned in 1964, and now the underwriter must rate the borrower, the property, location as reject, fair, good, or excellent. Kind of like what happened in grading in schools. And it went from 60, 70, 80, 90, 100 to A, B, C, D, and then the curve changed, and who knows what. It becomes very subjective. The result was dramatic. You see where FHA was. This is per 1,000 loans. So these are not 2%, it's 0.2%. And FHA's default rate soars. Actually, Time Magazine has an article in 1962 commenting on this, that the troubling new trend called jingle mail, as people take the keys to their FHA homes and put them in the mailbox in an envelope. At least they were doing that back then. They stopped doing that eventually. FHA mortgages became another word for trouble. 3.4 million foreclosures, 1 in 8 families who got an FHA loan from 1975 to 2013. I do not view that as a record to be proud of. FHA, I think, does, but they don't acknowledge it. But these are the facts taken directly from their own documents, their own actuarial studies. So we have competing valuation theories today. This goes back to what we were talking about earlier. We have FHA's warranted value, the German mortgage lending value. We've got the exchange value or point-in-time value, and we have the reconciliation of the 3 approaches. By 1992, as I said, Congress mandates Fannie and Freddie. And this gets back to the discussion we had earlier that related to Michael's presentation, why 1990 is really the spot you need to start. This shows how down payments increased or decreased for Fannie, Freddie, and FHA. In 1991, virtually no FHA loans had a down payment of less than 3%. And Fannie and Freddie had none. It wasn't until 1994, in response to the 92 Act, that Fannie even got and Freddie got into the 97% business. And you see how these percentages went up over time. DTIs in excess of traditional levels also were rapidly changing. You see what they were in the random sample, and we look at this chart, and you can see that in 1989 to 1992, I've estimated that based on the distribution from that random sample, that 0% rounds to zero, of the loans had debt-to-income ratios of greater than 42. Remember, today, the CFPB defines 43 as the reasonable number or the maximum, which they then exempt 75% of the market from complying with. That percentage reached 44%, from 0 to 44%, from 1990 roughly to 2007. The DTI in the 75th percentile went from 36% to 49%. Again, I think it was Senator Isaacson yesterday said, oh, well, what was the DTIs, back when? 43%. It's like, no, 2836. This is the evidence right here. 2836 was the standard. Performance then worsened. We'll go through these quickly. You have them. This shows over 88 to 2003 how the performance changed. It was a slow change, as much of this was. It really was the frog in the pan of water set on a very slow boil. But as time went on, not only did the DTIs get higher and higher, but then performance got worse and worse. Then we had the growth in Alt-A, including low-doc, no-doc, which we show here both Alt-A by non-agency, net of Fannie and Freddie's purchases, and Fannie and Freddie's acquisitions and purchases of Alt-A. And what you see is not only did they get in early, the data starts in 2001, so I can't even show anything before that, and it's partial for 2001, but you see 2002, they were already dominating the Alt-A market, 2002. And they went on to dominate it for the rest of the time period. This next chart is from CoreLogic. Excellent bit of research here. I commend them for figuring this out. How do you figure out how much misrepresentation is actually going on? Well, they basically said, look, what we do know is how much incomes are going up. And if you have enough data, if you know the universe of people who are getting loans, then their incomes year to year of people buying a house should be going up whatever the average is that's going up. If 3% is the average, that's what it, and lo and behold, they looked and they said, yeah, that's documented incomes were going up 3% or whatever the number was. Well, how much did low doc, no doc incomes go up? Well, it was a little different. You see, it was 20, 30, 40, 60% higher. And therein lies the problem. So you had increasing debt to incomes, and on top of that, misrepresentation of incomes. And I said on top of that, you then had this problem of you weren't counting the cost to commute. This gets to the FHA, excuse me, it gets to the FICO. You have that one distribution. This goes through 3 different periods as benchmarks. 87, which is the 1989 release, because it's a 2-year period. 92, which would have been 90 to 91, 92, or 90 to 91. And then 2005, which would have been 2003, 2004. So there's always a 2-year look back on FICO. And this is what Freddie Mac called unacceptable credit back in 1997. They eventually deviated from this quite a bit, but they basically said, you know, if you've got a FICO score of this, when we look at the actual credit reports, we think it's unacceptable to this level of percentage. I won't go through this 2-commuter household. The point is it's a huge impact. If you're commuting 30, 40 miles, it's huge. The other thing is fuel costs quadrupled from, tripled, not quadrupled, tripled from the early 2000s, 2004 to 2008. If you're in Riverside, San Bernardino, and you're driving 30 miles each way to work, and the price of gasoline triples over that time period, I think Penny Reed is the one that actually has been talking about that here at this conference and before for many years. We've now starting to figure out how do we document this. But this is huge. You've already seen the presentation on the National Mortgage Risk Index. This is just some of the information that is behind that index. FICO and LTVs are highly determinative of default rates on home purchase loans 2007 vintage. FICO scores at origination, CLTVs at origination do matter, and they're predictive. This last chart, increasing leverage drove the boom. This is a Fannie Mae chart that I just found that ends, ironically, right before the wheels fall off of everything. So they're tracking 100 markets, 100 markets. And all they're doing is saying, are the markets going down in value on a rolling 4-quarter, going up a certain amount, going up more, going up more? Just focus on the red. Those are the markets that are going down. And I call this the flame stitch chart. And if you just focus on the ones that are red, you see that they dropped to 0 in the late 70s, which then led to COLTA, the Colorado, Oklahoma, Louisiana, Texas, and Alaska. And that's where you see this big jump up in the early 80s. And then you see that jump up that I mentioned earlier when house prices in Washington were bouncing along in the early 90s. Well, they weren't. They were bouncing down in Riverside, San Bernardino, Southern California, et cetera, and the Northeast, although it was a little bit earlier in the Northeast in New York. And then you see the great moderation, so-called, which was the period that Michael pointed out, this 15-year period, that nothing is happening. Well, house prices are going up, but there aren't any house prices going down. So what kind of mortgage product best meets the needs? We'll talk about that in a moment, but we think the 30-year mortgage is not the right product for most low and middle income people. Last week, Joseph Smith, the monitor for the National Mortgage Settlement, spoke at the American Mortgage Conference and said, I've done a lot of listening in the past 2.5 years, including to distressed borrowers, the people who represent them, and public officials who deal with the fallout. What I've heard confirms what I know from prior experience. One or two of these life issues, or many, in the case of many, 3, have resulted in real financial loss. Absent substantial home equity at the outset, the 30-year fixed-rate mortgage increases the fragility of the borrower's overall financial position and puts the borrower at risk for a very long time. And that's what a lot of the research that we've done shows. This you already have. With that, I will turn it over to Susan as discussing.
Talk. I said thank you for being invited. Ed's talk today shows the importance of taking a long-run perspective in issues that matter. And of course, nothing matters more than the incredible instability which almost brought the economy of the world down. Ed, in his presentation, provides historical perspective, not only in facts, data, but also in history of thought. The presentation is really 2. First, an historical review of appraisal theory and practice, what we can learn, and perhaps what we have forgotten. And second, a quick review of what happened. But Ed starts, and I should, thank you. So the contributions are how theory and practice of appraisal have evolved, what we can learn, the importance of these practices for price stability, and particularly mortgage industry structure, and finally, where he starts, that leverage and risks matter for individual household wealth building. Averages are deceiving. What's interesting and different than the stock market, where Shiller shows that overall volatility exceeds individual stock volatility, in this path-breaking work is, in fact, individual houses, neighborhood and individual house volatility exceeds overall volatility. This makes mortgage debt buildup, of course, critical, and Ed points to the importance of that and the importance we'll see more of in terms of, in later presentation this afternoon, of the form of the mortgage. But the 20-year mortgage, or rather 15-year mortgage that Ed uses in the simulation versus the 30-year results in very different wealth outcomes of 30,000 losses versus 124,000 losses in his simulations. So in the slide presentations that I received, this was first, so I'm going to go in this order, hopefully not confusing everybody. But theory and practice in some ways does come first, because theory does inform practice. And Ed reminds us that our intellectual forebears that founded our field came up with the very important concept of intrinsic value. Babcock, Eli, Hurd, and then they went to FHA and affected practice. Concepts are important. The intrinsic value concept is important, as Ed points out, because it's jobs that creates income, that creates housing value. Mortgage debt's important for smoothing consumption, but in fact can be destabilizing. But not so fast. Fundamental value is not simply a matter, of course, of use value. It's a matter of that cap rate that our intellectual forebears were well aware of. But what determines that cap rate? What is the role of interest rates, the risk premium in fundamental value? What is the role of expected appreciation rate? They all obviously have a role. It's not just the numerator, the value in use, it's the denominator that determines the value. Are the interest rates, the risk premium, expected appreciation rate efficiently determined? Well, in short, rational pricing theory says yes. And Ed opposes rational pricing theory to intrinsic value. Rational pricing theory, points out, led to a move away from intrinsic value. But we know that market prices are determined not only by rationally determined variables, but also by lending rates and terms, and that these are in fact determined by past risk, not currently building risk. So that is inconsistent with rational expectations. Then Ed turns to the actual data, the outcomes of this shift away from a concept of intrinsic to a more volatile valuations. And he shows this graph, which has two lines, the blue and then the blue line and then the red bars. Now, I understand the blue line, and the blue, you can't take much comfort from the blue line, less comfort, of course, from the red, but even the blue line is quite volatile. What is the blue line? The blue line is very simply mortgage value and home prices. And as you can see, perhaps you can't see, but they moved together through 2007. That is, it's flat. From the late 1990s to 2007, mortgage lending and house prices moved together so that the ratio is flat. But again, as I said, can't take too much comfort from this because both are moving in ways that are destabilizing, both mortgage levels and prices. Ed also then shows in the red bars what is determined as fundamental in value and showing how volatile that was in the red lines. My concern is, again, what's determining fundamental value? We know that housing prices are unstable for a variety of reasons: elasticity, housing price supply inelasticity, and also lending terms volatility, which I'll come back to both in a moment. But we also know that there are real factors that affect valuation and that can explain the rise in both mortgages and prices in this period through 2000. Interest rates dramatically dropped, both real and nominal, from 12% to 4%. This dramatic drop, I just want to note, ends in the years 2003 to 2005-06. At that point, interest rates flatten out and rise slightly. A point I want to come back to, because you cannot explain the blowout in housing prices from 2003 and mortgage loans levels, also 2003 to 2007, by interest rate decline. But prior to that, you could. Similarly, rents increase. So there is an element of expected price increases that is rational, based on expected rent increases. There appears to be a regime shift somewhere in the late 1990s where rents, for the first time, do outpace inflation. Now let's turn to Europe, because this is an international housing bubble that we've experienced, and credit bubble. I'm not showing the credit data, but in a presentation that I just did, I have that in a paper that's just coming out in JMCB, just goes over this very quickly. So I don't know if you can tell me what country is not going up in these many countries with bubbles, but to help you on that, here are the bubble countries of Europe. And they do not include Germany, which is basically flat. Somehow escaped this global housing bubble, which some have attributed to global savings glut, to foreign exchange issues, but clearly Germany is not part of this. There are some practices. So the key really is making these connections to appraisal theory and practice and mortgage lending theory and practice to outcomes. And I think that this is a key slide that was in, I'm not sure if you showed it, but in the original that I saw, and goes back to the concept of warranted value and the German mortgage lending value that we heard about in the previous panel, and contrasts that to point-in-time value, and then points to the issue of reconciliation. I think we need to understand more, at least I do, of how the choice between the mortgage lending value based on cost versus market comparables is done in Germany. And we can learn from that. Not that we can easily simply transfer practices from other countries, but we can adopt those practices, and it's going to take work, but the work is happening right here and now, here at AEI, by Ed, others, and folks in this room. But then let's again go to what happened and the importance of this work. So we had this period of stability in mortgage lending, and we had a huge increase in home ownership through to 62%, not too different from what it is today. And that's associated with the FHA innovation of a self-amortizing fixed-rate mortgage, which originally was 20 years, became 30 years by the early 1960s. Now, in that dramatic-looking graph, which I didn't include in my slides, but in any case, at the very high point, the FHA foreclosure rate is 1.2% in 1966. But then it does go to an order of magnitude larger than that in this historically horribly destabilizing period, in the average of 1975 to 2013, but obviously it's in the period of after 2007. So we have disaster. Now for Ed, market structure matters. For me, market structure matters. For Ed, 1992 is important in market structure. And that's the year that, to quote Ed's words, Congress mandates Fannie and Freddie to compete with FHA and subprime. And then Ed goes on to the deterioration in underwriting. I think market structure is critically important, and I do think it has links to the deterioration in underwriting. I'm going to come back to those links in a moment, although I don't agree that it's 1992 that is the market structure point of departure. But I absolutely agree with all of these, that the underwriting deteriorates in every way possible. DTI, Alt-A, CLTV, and FICO. And the outcome is disaster. This is my favorite chart, if you can talk about favorites when you're speaking about disaster. The top line is the subprime adjustable rate mortgages. That looks like a 7% foreclosure rate, but that's quarterly. So nearly a third, 1 in 3 mortgages in foreclosure, not just default. So what's the work that we need to do? And there's much to be done. First of all, it does seem to me that credit supply is critical here. And particularly it's the interaction of credit supply with what I regard as the incompleteness of housing and real estate markets in general. That is the limited arbitrage, that is the lack of the ability of short selling that generates systemic risk. So adding underpricing of risk in mortgages that creates non-traditional mortgage that are riskier, that are in fact riskier than they're perceived, but takes time to be revealed. Add that also to the inelasticity of supply, which means that prices go up in the short run and then decrease in the longer run, and that is part of housing. So we need to understand those dynamics. We need to understand the dynamics of housing instability through supply inelasticity, short run, long run. We need to understand the role of mortgage lending terms themselves. And we need to link to the macro literature, where externalities and information failure in this, in housing and real estate, are being worked on as we speak and are leading to macroprudential regulations. We need to make those linkages with that work that's being done now. So in conclusion, financial stability is a public good, and appraisal and underwriting practices are key to those. How do we improve the stabilizing function of appraisal and underwriting? Much work yet needs to be done. But we do agree that we need long-term mortgages. We do agree that we need securitization. And we therefore agree that we need housing finance reform. So one more item on the to-do list is, how does all this relate to housing finance reform? But in the meantime, congratulations to Ed and to his team and to all of you who are working on this. This is important work. Thank you.
Thank you, Susan. We've shifted the 15 minutes that was at the end of our extra questions to accommodate this here with the lunch and the presentation. So we're actually going to go for about another 8 or 9 minutes and take some questions, and then we'll stop and switch to the next panel. So questions? Tom?
Well, I'm not sure there was a catalyst year, but I do think that the structure of the mortgage lending market is absolutely critical. I don't know that we have an answer, and not one at least that I'm prepared to give today. I'm working on that.
The reason I point to 1992 is a couple of things. One is in 1991, Gail Sincata, known as the mother of CRA, somebody I knew personally back in the mid-'80s when I was at Fannie Mae, testified before the Senate Banking Committee and said, if I might paraphrase, lending institutions will not give up their traditional narrow underwriting standards unless and until Fannie Mae abandon, or I forget the words, but give up theirs. And in 1992, and there's documentation of this in a book that was edited by Gregory Squires in 2003. There's a section or a chapter written by Alan Fishbein where he talks about the affordable housing goals and the inclusion in the 1992 Safety and Soundness Act, and he talks about how the chairman of the Financial Services Committee, Henry B. Gonzalez, deputizes a group of nonprofits led by Acorn, among others, to write that provision and get Fannie and Freddie to agree to it. It was basically Fannie, which they eventually did. But in that statute, which set up the goal regime, there was also a study that was mandated. I spent a long time trying to find copies of that study. I've never been able to find it. Fannie and Freddie were each mandated to do a study. It was submitted, but there are no extant copies that I've been able to find. But the study asked these questions, and believe me, when Congress asks these questions, you don't have to use much imagination to know what answer they were looking for. Why shouldn't Fannie and Freddie have down payments of 5% or less? Why shouldn't Fannie and Freddie accept cash at closing? Why shouldn't Fannie and Freddie accept non-traditional credit standards? What we do know, what I was able to find, was the year later, actually 6 months later, Fannie Mae enters into a commitment with Acorn to do exactly those three things. And I also know that in 2003, the next year, Fannie puts out, and I have the document in my files, puts out a side-by-side comparison of Fannie Mae and FHA and why Fannie Mae is better than FHA 203B, the benchmark FHA program, in 1993. I was chief credit officer at Fannie Mae up until 1989. If you'd asked me then to come up with a program to compete with FHA, I literally would have thought you were from Mars. It just would have, I wouldn't know what you were talking about. But here it is in 2003, that's exactly what they were doing. So that's why I say they were really put in competition with subprime and the thing, and FHA. The thing you need to know about both of those is it wasn't just the credit and the LTV, it was debt to income ratio, and I've documented that the debt to income ratios starting right after this, I can only pick it up in 1996, but I can show you where it was before, just started going up and up and up and up every year by Fannie and Freddie. And that was a big, those loans that they were doing above 40-something%, whatever the number was, 45%, would have been considered, and Tom LaMalfa provided this background documentation, subprime in 1990. Those were, that was the definition of subprime, a debt ratio above 45%. Yeah.
Hi, Sam Cater from CoreLogic. It seems like every bubble of any kind over sort of the last several hundred years have been about asset liability mismatch or leverage. We saw the result of asset liability mismatch in the 80s with the thrifts, and it seems to me that this one was all about leverage. We can talk about all these other variables, but to me it's all about leverage. You guys identified Germany as a country that missed the housing bubble. I would identify another country, the Republic of Texas. And the reason I identify Texas is home equity is not allowed. And if we look at the incidence of second liens, when we look into our data, the incidence of exactly 80% LTV loans was about 10 to 15% prior to about 2003 or so. And then it zoomed up to about 40 to 45%. So you can clearly see in the data where suddenly there was a huge rise in first lien loans that were 80% only. No surprise, a lot of these had hidden seconds underneath. So can you talk about the role of leverage and versus the other variables that you talked about in terms of
Sure, but let's get a little more history further back for Texas. Remember I mentioned Colorado, Oklahoma, Louisiana, Texas, and Alaska. Texas's equity law, the homestead law as it's known, actually dates to 1860 something, I believe, was actually stronger in the early 1880s than it was. It was diluted slightly by the aught years. And so Texas had a huge run-up. And actually, this is the law of unintended consequences. What I found, because I was at Fannie Mae investigating what happened in Texas in the early 1980s, the realtors would go to a home buyer and say, do not put any money down. Put as little as you can, because you cannot get your equity back. You can't do it even for a home improvement. They eventually allowed home improvements, known as swimming pool loans in Texas, but you can't even get it back. And so the incidence of 95 and 97% loans, 97% with FHA, 95 with Fannie Mae and Freddie Mac, particularly Fannie Mae, was very high in the early 80s. It did not protect Texas. So leverage is very important. Credit is very important. And, you know, they're all important. The 80-20s, again, these are things we learned in 1985. In 1985, when we rewrote Fannie Mae's underwriting, we not only, as I said, limited debt-to-income ratios and limited the refi and cash-out refi LTVs. I still have the stripes in my back from the California Association of Realtors when I required that a combination loan be a 75-15, 75% first, 15% second. I end up going to U.S. League of Savings or something meeting in California. They meet with me and they just go, you don't understand. We use this to sell houses. And I said, you don't understand. We lose money on those loans. And we didn't change them, at least on my watch, but as you well know, they were changed radically afterwards. So there were a lot of things. Again, that's why I said there are 9 forms of leverage. Every one of them was being pushed. And it's very hard to figure out which is the one. All we know is that they were all being pushed. I would say this, Fannie and Freddie, this is my analysis after looking at this for years. I know they pushed the LTV leverage very early. Evidence 1993 is when the 97 came in. I believe they were willing to do that. I mean, they had pressure from the statute. They were willing to do that because they had a counterparty called a mortgage insurer, and they didn't view it as very risky to them. They were willing to increase debt to incomes, I think, just out of ignorance. They had forgotten, and they were deceived by what was known then as compensating factors. So when you look at that chart, you'll see that the default rate actually goes down in the data from the random sample once you get above a certain level. That's because those had compensating factors. Well, it's very hard to build a model when you don't know exactly how the compensating factors are working. And so they just assumed, well, as we raise the debt-to-income ratios, it doesn't mean much. And you see, for the first 5 years, that's why I split those charts out. For the first 5 years, it didn't seem to mean a lot. But then over time, it got to be more and more and more important. And so they felt that they could do that safely. They didn't push out on the acquisitions of whole loans on FICO scores that much, I believe, because they realized that risk layering with what else they were doing was going to be incredibly dangerous. And that's why they went and became the largest buyers of subprime private mortgage-backed securities in the world. And because they thought, again, that they can invest in those safely and still meet their goals. One more question.
Hi, Susan. Mike Radley from CoreLogic. Appreciate your comments, thoughtful as always. You mentioned about the need for the MBS to come back, right? And I think that there,
Sorry, I missed that.
you need it for the private label mortgage-backed security market to rebound. You know, whether you go the ABS East year after year after year, it's not happening. And there seems to be a failure of appreciating just how much Fannie and Freddie standardized the processes, at least through the origination. They failed by not standardizing the servicing aspect as well. But the folks on the street love to do deals, but they don't understand how to do processes. And so the question is, what's going to be required for that market to ever come back to life?
Right. So I do think there needs to be standardization for, among other things, for transparency, so that we can understand what the book of business is. Not we, but particularly the investors. The investors know, and they're blindsided if they invest today and they don't know what tomorrow's book of business that's affecting their risk. So that's why we don't see a huge growth in private label securitization in RMBS. We see it in CMBS. It's a whole different world, a whole different story. So I don't think the private securitizers are going to come back until we have that standardization. And the question that I have, and I don't have an answer for it, and it's a question that's being asked by Bank of England right now also, because it's the same issue in Europe, because they'd like to move away from the adjustable rate mortgage. They'd like to have securitization. And that is transparency. Is that enough, actually? Or do we require, do the private sector capital providers require something more? And that is a regulatory regime which at least has some element of setting the framework, maybe not 100% of the framework, but going back to a period where this was the case. I don't know. This is in the U.S. This would be so counter, where we not only have competition without regulation, but we have among our regulators competition. That's just the way we are. So we'll see how it goes.
Well, that will end this panel and call up the next panel. Thank you. Susan, thank you very much.